This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Okay, hello everyone out there. Welcome to episode 35 of Value Investing. In today's episode, what I'm going to do is I'm going to talk about Philip Fisher. And some of you guys might not know who this person is. So let me just try to give a little bit of background why I'm covering Philip Fisher. The number one reason why I got interested in this person is because Warren Buffett once said that he is 80% Ben Graham and 15% Philip Fisher. And Warren Buffett also mentioned that he is eager reader of whatever Philip Fisher has to say. And he definitely recommends Philip Fisher to people. If Warren Buffett says that he's 15% Philip Fisher, I wanted to know why he was so attracted to Philip Fisher. And everyone knows about Ben Graham, so that's nothing new. But Philip Fisher is relatively unknown to value investors, so let me just try to cover some of the important topics written in his book called Common Stocks and Uncommon Profits. I'm going to include the link for the book in case you want to buy it from Amazon. But I definitely recommend this book for anyone who's interested in investing in stocks. But Philip Fisher is sort of categorized as growth investor. So he put a lot of emphasis on growth, but Warren Buffett also thinks that this is an essential component of how you can make successful investment in the stock market. So before we get started, let me just give you a quick disclaimer that this podcast is for entertainment purposes only, and it is your responsibility to consult with your investment professional for any investment decisions. So without further ado, why don't we get started? So let's take a look at Philip Fisher's investment style and see how he managed his stock portfolio. So he's a long-term investor, there's no doubt about it. And one famous stock that he has held for his lifetime is Motorola. He has held onto this stock more than 50 years because he believed in the company. And I can summarize his investment styles in 4 bullet points. The first one is basically saying that he purchase and hold for the long term. He's a long-term investor. The second point is that he holds a concentrated portfolio. So this is quite similar to how Warren Buffett's partner, Charlie Munger, does for his portfolio, because Charlie Munger essentially holds 3 stocks in his portfolio, and Warren Buffett holds just basically one stock, which is Berkshire Hathaway. Majority of stakes are in this Berkshire Hathaway stock for Charlie Munger and Warren Buffett. The third point that I want to mention is that he emphasized about buying outstanding companies with compelling growth prospects. Again, here he has a lot of similarities with Charlie Munger because Warren Buffett initially started his investment partnership and he focused on Siga bus stock, which is just purely a value play. Warren Buffett wanted to buy stocks that are selling so cheap below working capital amount. But later he changed his strategy and he now buys a lot of companies with good business models. The last point that I want to mention is that he wants to buy companies that he understands very well. So this is also kind of aligned with Warren Buffett and Charlie Munger. What I want to do here is that I want to actually go over 15 points that he mentioned in his book. I don't think that I can cover all the points in today's episode, so I'm gonna cover half of these points in today's episode, and the next episode I'm gonna cover the other half. So let's get started on the first point. The first point that he's basically saying when it comes to buying a stock, so you basically have to ask these 15 questions to yourself whether this is the right company. And he also mentioned that you don't have to satisfy all these 15 points when you are making buying decision, but at least the companies that you are interested in buying should have some good qualitative aspects related to these 15 points. So let's just go on to the first point and see which question he's asking first. The first question he's asking is, does the company have products and services with sufficient market potential to make possible a sizable increase in sales for at least several years? Here, Philip Fisher basically putting a lot of emphasis on growth and see if there's enough market for the products and services that the company is making. Growth aspects should be incorporated into your analysis. If you're a value investor, it's not saying that you shouldn't think about growth aspect. It's not black and white. Even if you're a value investor, you look at the price, and when you calculate intrinsic value, if company has a good growth prospect, then you definitely need to increase intrinsic value of the company. Philip Fisher here wants to know if there's enough market for this company's products and services. In his book, he talked about two different groups. The first group is called Fortunate and Able, and the other group is called Fortunate because they are able. The Fortunate and Able group consists of well-run companies that also benefit from secular tailwind. So if industry is going up all at the same time, then there are companies benefiting from this industry trend. So look at a lot of e-commerce companies these days, because everyone is now trying to move on to this e-commerce platform whenever they do some shopping. So there's a huge secular tailwind for a lot of e-commerce companies in the US and around the world. So that's one good example about Fortunate and Able group, and there are a bunch of companies in this space. The reason why he mentioned here is because he's basically saying that if you invest your money in this group, then you can make money. Some of the examples are like eBay, Amazon, and these other companies that were able to make money from this secular tailwind. The second group is called Fortunate because they are able. This group consists of companies that create their own luck by reinventing the business or by introducing new products, shifting strategies, and so on and so forth. So think about Apple. Apple created the whole new industry through innovation. So everyone agrees on that. And because of that, company was able to grow quite significantly from nothing to billion-dollar company. Look at other companies like Tesla, Uber. These are the pioneer companies that created their own industry, and as a result, they were able to grow their market cap quite significantly. So Philip Fisher is categorizing these companies as fortunate because they are able. So once you understand these two categories, fortunate and able, and fortunate because they are able, then you should be able to make money from either of these groups. You just need to do some research and see if there is some sizable market in the future, at least for several years in the future, about the services and products. The second question that Philip Fisher asks is, does the management have a determination to continue to develop products and processes that will further increase total sales potentials when the growth potentials of current attractive product lines are largely being exploited? This may sound a lot like the first point, but there's a key difference here. Philip Fisher is saying that it is a matter of management's attitude. So if management attitude is more geared towards growth, then there is a lot more possibility that the company is going to grow in the future. And if management is complacent with where they are, and if they don't have growth mindset, you're not going to be able to see the growth in the future. But luckily, a lot of US companies are leaning towards growth mindset these days. If you dial into a lot of conference calls, management team at least mentions growth prospect in the future for the company, and that's what a lot of investors like to hear. But if you see some management team who are just trying to maintain their market share, they're not interested in growing their business, then that's something that you want to avoid. That's what Philip Fisher said. Because if you really truly want to see your stock capital appreciation in the future, like 2 times or 10 times or even 100 times capital appreciation, could happen only through growth. And if you buy sizable stock, so sizable stock is the stock that you buy below, let's say, working capital amount or below the cash amount, below certain book value, you're gonna get good one-time profit. But once stock price goes up to that whatever threshold that you set, if the company doesn't grow, then you're not gonna get like 10 times of capital appreciation. So you can only make 10 times of your initial investment through this kind of growth company. So here, again, going back to the second point, you want to find a management team who focus a lot on growth aspect in the future, and you can easily follow their mindset and their strategy by dialing into quarterly earnings call. Let's move on to the third point. The third point is basically saying that how effective are the company's research and development efforts in relation to its size. Philip Fisher is putting a lot of emphasis on R&D here, research and development. And how many times have you seen people focusing on this R&D amount? I mean, you can easily calculate the ratio R&D expense divided by total sales and compare that figure against competitors and see how much emphasis the company is putting on R&D. The reason why Philip Fisher is mentioning here the importance of R&D is because R&D is kind of the key to the future growth of the company. If the company putting a lot of money in R&D expense and develops good products that are not in the market, then the company's revenue can grow in the future. That's just kind of the bottom line. But here, it's not just simply comparing this R&D expense to total sales ratio, because that's just crude yardstick for you to understand the effectiveness R&D expense. So you have to ask management team, you have to ask maybe employees, and that's called scuttlebutt approach. So scuttlebutt is the verb created by Philip Fisher where the investors kind of try to get information from all sources, including employees, customers, suppliers, and so on and so forth. And this is what Peter Lynch does as well. But going back to point 3, if you look at the past performance, then you will also understand how effective R&D expense has been in the past and see how much revenue, the current revenue is from one product versus the other. And you'll see over time where each segment of revenue is coming from and which products. If that kind of information is readily available, I think it's good for you to do the analysis. If not, then try to do the scuttlebutt approach and try to understand what kind of information you can gather from Google, internet, and by talking to people related to that company. Okay, so let's move on to the fourth question that you may need to ask when it comes to buying a stock or buying a company in the stock market. Philip Fisher wants you to ask this question. Does the company have an above average sales organization? This is an often overlooked area of research, and it's similar to the previous point where we are talking about research and development. But if you want to know how well the company is managing its sales organization, there's no way you can find this information from financial statements. So this has a lot of qualitative aspects that you may have to find out by doing a scuttlebutt approach here again. Think about any services, any products that you buy. If you don't have good experience from, let's say, a restaurant, then you're not going to go to the restaurant again, even if the food is really good. So if you're a company making great products, but if your sales force or your sales organization is not making customers happy and clients happy, then they're not going to come back to you with more revenue. It's common sense that sales organization is important for your research, but it's just not easy to find out this information. So you might have to go through that scuttlebutt approach. But these days, you can find a lot of information online. You can go to different review sites, or you can go to Glassdoor, for example, if you are trying to understand how employees think about the firm. So whenever you do your research on the stocks, it's likely that you'll find that company's information online a lot. I think these days you have to make use of all the information easily available online that weren't available back then when Philip Fisher wrote this book. But scuttlebutt approach again is very useful tool, so don't underestimate the power of talking to people in person and asking them, if possible, if you're truly interested in buying significant portion of a certain company for your portfolio. And this is qualitative approach, and you can ask customers, suppliers, competitors who has the best sales force in the industry and see if this company has good sales force as well. And if you can get the company on the phone, ask them how their sales force is rewarded and if their incentives are appropriately set in place. One point that I want to also bring up here is that, as I mentioned, so far we talked about 4 different questions, and every single question is related to qualitative factor. Philip Fisher is not a big fan of quantitative factor and quantitative metrics. So that's another thing that you have to keep in mind when you read his book. Let's move on to the next question, which is more related to quantitative metric. Philip Fisher wants to ask this question: does the company have a worthwhile profit margin? And this is first time that he's bringing up this quantitative metric. As Philip Fisher puts it, the greatest long-range investment profits are never obtained by investing in marginal companies. If the company is doing something remarkable, the company should have good products with high profit margin. In many cases, these companies can sell their products with high profit margin because either customer has high loyalty attached to the product or attached to the company. Look at the iPhone. People are willing to pay $1,000 for a smartphone from Apple, which is quite a lot compared to other smartphones out there in terms of features, in terms of what you can get by paying $1,000. It's not much if you compare against competitor products, but people are willing to pay that much money because the product is from Apple. So that's why Apple is considered a great company for investors, and that's what Philip Fisher is mentioning here. But there are some exceptions. For example, firms can have low profit margins and high asset turnover and generate good returns on equity. Look at what happened to the investors from Costco, Walmart, Amazon, etc. Because these companies have very, very thin, low profit margins, but still can produce high returns on equity and subsequently bring huge capital appreciation for their investors. But Philip Fisher is not a big fan of low margin business, and I think understandably he prefers high profit margin business, which is common sense, so I don't disagree with that. The next question is also related to fifth question that we just talked about with respect to profit margin. The sixth question that Philip Fisher asked in his book is, what is the company doing to maintain or improve profit margins? The fifth question was about profit margin itself, and sixth question is more about what the management and company is doing right now in order to improve profit margins. This is also a qualitative thing because you have to listen to what management is saying to understand if they have a specific plan to improve their profit margins. And also the best way I think that you can get this information is by listening to earnings calls from the management team and see what plans they have to improve their profit margins in the future. if profit margins deteriorate in the future, then that's going to directly hit the bottom line and net income. So that's not good for shareholders. So you want to be mindful about the plans of this management team and company in terms of profit margin and growth aspect in the future. But I'm not really particularly concerned about these points because in today's environment, investors and analysts ask these questions a lot during earnings call. So whenever I listen to earnings calls for various companies that I already hold in my portfolio, key questions that these analysts ask to management team is growth aspect of the company, so which was already covered by Philip Fisher. And also analysts are very particular about profit margin prospects in the future. So you can get this kind of information by listening to earnings call easily, and that's just my opinion. So let's move on to the next question. Next question is, does the company have outstanding labor and personnel relations? Put it another way, are the rank and file employees passionate about working for the company? This is also a qualitative factor. If employees are happy and enthusiastic about working for the company, then the company's productivity is going to go up and company's profitability will also go up along the way. The best place I think that you can get this information is online. These days, you don't have to ask employees in person because all this information is available online. Of course, it's probably good if you know someone working for the company. It's better to ask like in person how the culture is for the company and how the management team is treating their employees and so on and so forth. But if you don't have that access to these employees, the next best thing you can do is go online. There are a bunch of websites where you can review a lot of these employees' comments about the company. One website that I like to usually go, which I already mentioned in this episode, is Glassdoor. Because Glassdoor provides a lot of good reviews from employees and honest reviews because they're usually anonymous, so they don't have to think about politics when they provide their reviews on their companies. So I like to review and get a feel for how it's like to work within this company. And honestly, it's free. So you should definitely take advantage of the information out there online and assess the situation in an appropriate manner for your investment decision. Okay, so let's move on to the last question for today's episode, which is, does the company have outstanding executive relations? So this is similar to the previous point that we just discussed, but it's more related to executive team rather than employees. Philip Fisher said in his book that executive personnel is vital for investor success. The company offering greatest investment opportunities will be the one in which there's a good executive climate. That's what Philip Fisher said in his book. And he really thinks that the promotions should be based on ability, and ruling family is not promoted over the heads of more able men. And salary should be at least in line with the standard of the industry and so on and so forth. And he thinks that executives should be able and also honest and should have some integrity. So in that sense, he's similar to Warren Buffett. And last point that I want to mention here is that you also want to check out proxy statement, because proxy statement document has information, a lot of information in detail with respect to executive pay. Executive pay packages are very sensitive information, but it's out in public. So why don't you just go there and try to review executive packages and see if it is in line with shareholders' interest. In some cases, they are not, and in other cases, they are. And also try to look at the level of the pay that the executive teams are getting as part of their business operation. Because in some cases, executives just get paid a lot without any outstanding performance. And that's a huge downside for investors. Because investors obviously would suffer from underperformance if the company is not doing well, but the executive is getting paid a lot. That means the executive is just not doing their job and they're just serving for themselves, not for investors. So proxy document, definitely check it out. It should have a lot of details regarding executive pay, and that's what I do for my stock holdings. Okay, so that's it for today's episode. We talked about 8 different questions that Philip Fisher mentioned in his book in terms of what kind of things you need to research on when it comes to buying a stock. So what we're going to do in the next episode is we're going to cover the remaining 7 questions in his book in this space. As you can see, and as I mentioned, there are a lot of qualitative factors that Philip Fisher wants you to focus on when buying a stock. What happens usually is that we get influenced by a lot of quantitative factors. For example, when you go out and try to find companies that you want to include in your portfolio, the first thing you might do is just run a screen. Whether it's from Google, Yahoo, there's a lot of stock screeners. But you only focus on quantitative factors by doing that exercise. If you truly want to find good companies, outstanding companies, you're not going to be able to find through screeners, because that's what a lot of people do. And if that's the case, then it's not likely that you're going to find outstanding companies. So if you apply Philip Fisher's questions and filters, then you'll likely find outstanding companies through qualitative factors. And I'm not saying that quantitative factors are not important, but you have to incorporate the right mix between qualitative and quantitative aspects of the company. But I'm just saying that a lot of investors just put too much focus on quantitative factors instead, and that's not the way you find outstanding companies. And before I end, I just want to remind you that just leave comments and your review on whichever platform you listen to this podcast. I highly appreciate your support, and that's it. So see you next time. Thank you.